Welcome, viewers. Before we dive into today's episode, we want to offer a quick note to our listeners. We experienced a few unexpected technical hiccups during the recording, including some audio challenges, and unfortunately, Jerry having to drop out partway through to connectivity issues. So, our apologies and thanks for sticking with us. But let's now get into the episode.
Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome to episode 4 of Turtle Talk. It's Friday, the 27th of June, 2025. I'm Rich Brennan, and I'm joined by my fellow Aussie turtle, Adam Havriliv, and the one and only Jerry Parker. Today, we're flipping the script a bit because our guest doesn't run a CTA. He allocates to them. We're thrilled to welcome Dr. Kevin Mackey, an evidence-driven investor with a background in biomedical research, a sharp eye for statistical rigor, and a long journey from value investing to systematic momentum and trend. In our Spotlight segment today, we'll be diving into Kevin's insights on trend following from the allocator's seat, how he thinks about allocating to trend strategies, what he looks for in manager selection and due diligence, and how he builds portfolios that balance evidence, diversification, and adaptability. But first, let's do a quick check-in. Adam, how are things down in Sydney this week?
Well, getting through the winter and living the trend-following dream.
Jerry, how are things your end? So New York today?
Yes, I'm in Montauk, New York today, and it's been very warm up here, but kind of cloudy today and rainy. So back to the June weather in the Hamptons that I'm used to. Should start getting really nice later next month in August. But yeah, having a little fun vacation now.
This is how the world balances out. It's freezing down here and it's warm up there. Now, Kevin, welcome to Turtle Talk. And what's the weather like in your part of the world? I believe it's Las Vegas.
Yes, so yesterday I flew from hot and humid Florida to hot and dry Las Vegas. And so things are great here, sunny and warm as you expect this time of year. So thanks so much for having me on.
Great to have you on. All right, gentlemen, so let's get this started. First up, it's time for Battle of the Trend Following Indexes. Adam, lead us into the May scoreboard.
Yes, sure, Rich. So a stabilization in our programs. We're happy to report that Classic Trend Index returned a positive return in May. And I note here that actually we're the only ones in black when compared to the other indices that we compare. And so that's a great result of the blended 3 programs that the index represents. And look, there is a bit of red across the board here on quarter-on-quarter performance, year-to-date, last 12 months. But I guess that is the potentially the opportunity for investors to look at a strategy more broadly, not just our index, but a strategy with a positive expectancy that's in a drawdown. So hopefully people are doing their due diligence and running the ruler over their favorite manager or index because, this drawdown too should pass, shall pass, and hopefully we've seen the bottom. We've seen the bottom of it. And in the meantime, enjoy the weather and enjoy the ride, as Mr. Tom Basso would say.
I've noticed, interestingly, that almost every index here is at their maximum drawdowns now. So it's a particularly wicked period, this 2025. Jerry, what are your thoughts?
Well, I think, we're starting to see some trends start up again, and I was a little down on the currencies. They wouldn't make new highs. So they look like they're strong again, and they're making new highs. So I think I'm getting optimistic all of a sudden that we may have seen the worst, and we see some things happening now. I've noticed, scroll through my charts, that a lot of the markets that we don't really have a position in or aren't moving too much, the volatility is getting lower and lower. And so that's a good sign too. I think the interest rates, the ATRs are pretty much at near all-time lows or last couple of years lows. So that's really a good sign that people are getting discouraged and that there's no interest in some of these markets are kind of dead. They haven't trended in a long time. And plus, mathematically, we can throw in a big position when it hits the breakout because it will size that thing based upon the inversely to the ATR. So for the first time in a while, I have a little bit more optimism that maybe we're going to start seeing some good markets for the second half of the year.
Yeah, well, the good thing about trend following, as opposed to, say, buy and hold, is that when we get into these steep drawdowns, we find that risk release mechanisms of our portfolios are all sort of closing out trades, not holding on to them. So as we dive into these drawdowns, there is this fairly quick acceleration into a drawdown, but then it starts significantly reducing in levels of volatility because our risk release valves in our portfolio are all activating. And while conditions might remain unfavorable for a while, it means that typically a trend follower will probably have less overall exposure to that negative regime once those risk release mechanisms have got rid of that excess risk from the whipsaws and the reversals. So at least that's the good thing about trend following in general, is it doesn't hold on to risk. It adapts. It gets rid of that risk. So, Adam, what are your thoughts about the drawdown at the moment?
Well, I mean, big picture, it's an opportunity, I think. It's often tough when you get the risk reduction as you describe it. I mean, it's a bit of a wipeout, to be honest. I was looking at some historical data on SG trend, and this drawdown is right up there, so it's pretty serious. And, for individual traders going into it, if your leverage was too high, a 20% drawdown could be a bigger drawdown, depending on the volatility that you've got on. And so all these products are going to have different drawdowns based on the volatility parameters that have been defined by the firms or the individual traders. So we've had the risk reduction or wipeout, and now potentially the existing trends reassert themselves. And you'll be sitting there and cursing the screen because if only we'd held on and hadn't liquidated those trades, we could have made even more money, or we wouldn't have suffered those realised losses. But then conversely, we could be entering an entirely different trend regime with a different narrative. And so it's always difficult to, rebalance yourself after a knock like this. So hopefully everybody has managed their risk into the drawdown, and then still has enough capital to to trade out of it successfully. And I think that's kind of the point in the timing now. I think we're sort of hopefully seeing the bottom of the drawdown and coming out of it, and I just hope that everybody's got the ability to get back on to the tiger.
So, listen, Kevin, I'd be very interested to hear your perspectives of this particular regime we're in at the moment, both from, well, I know that you do your trading yourself, but also you're an investor in allocating to some of the trend followers. So what goes through your head in periods like this? Because I'd love to hear from the investor's perspective how they deal with these, like you're hearing from the manager's perspective now, but I'd love to hear from the investor's perspective how you feel about this.
Well, for me, what I do is I look back at history and I say, well, what's the worst I can expect based on history? And then I assume that the worst drawdown is actually going to be beyond what we've seen historically. So, we're in a 1 in 20, 25 year kind of drawdown for managed futures trend following now. But, we've had tough periods before. So in a diversified portfolio, there's always something to hate. Managed futures trend following is that thing right now. Some other things I do are working better. And so I'm going to just grit my teeth and wait it out. As long as I have faith in the process and the long-term edge, I'm just going to stick with it.
It's interesting to hear because often we find this is the time of redemptions for the investors who, invest in trend following. They're inevitably pulling out when these periods occur, and that's probably the very worst time to do it. It's great to hear the thoughts from the investors' side of things about, how they deal with regimes such as this. So, welcome to What's Moved the Needle. This is where we break down the charts and the key market moves of the month. This month, we saw some more whipsaw conditions and sudden price shifts, a tough backdrop for most trend systems. Adam, which futures chart stood out to you the most in May?
I know Jerry and I have submitted the same chart, but I think we're both very, very interested in platinum at the moment. And I was thinking about this earlier. I thought it's got cocoa vibes in the way that it's starting to perform. And then I thought, well, hang on, it's not that I'm actually predicting that it's going to behave like cocoa, which was one of our favorite trades over the last couple of years and really made a difference to our overall performance. This one individual market made a huge difference. And if you didn't have it in the portfolio, you would have underperformed or had significantly less performance. And what I really mean is not that it's going to do what cocoa did, but it appears to be doing what cocoa did. And so I'm excited about the trade because, we have it in our on our books and it's starting to perform well. But interestingly, we're definitely above the 12-month high on the platinum market. And for a bigger perspective, I've included a 5-year chart. And you can see there, we're sort of making 4 or 5 year highs now in the platinum market. And that's certainly something to be excited about. And, hopefully everybody, has this exposure in their trend following programs. And it's quite likely that you do because it's a very liquid contract. And I think a lot of managers or most managers should have it in their portfolio. So hopefully everyone is starting to reap the rewards of this emerging trend, which may or may not continue. I don't think we're predicting that it will. It just looks like it is starting to behave like a big winning trade.
It certainly does. So it's exploded. There's been this protracted period of congestion for a long period of time, and now we've got this explosive breakout to the north, to the upside. It's a very powerful looking trend there. So yes. that's a good chart.
And then on the flip side, this has been just an absolutely crazy month for crude oil and the energy complex. And, we've gone from a bear market positioning for trend following models in crude oil and the other energy products to a huge reversal that would have probably stopped out most short players. Oil has been wild and a whipsaw. And obviously there's a lot of news flow in that space. And I've been thinking about it quite a lot. And, this sort of noise to signal ratio has just gone, through the roof with oil because every day there's a headline that sounds like it can be or it is market moving and potentially significantly so. So people start throwing out predictions of 120, 140, $300 oil. And naturally, that starts to feed into the brain and affect potentially people's thinking about this market. But long-term trend following, I mean, there probably are only a few signal levels to get involved in. And I think, positioning was short for trend following into that squeeze, and then potentially people have now gotten long, and now we're back into the middle yearly range. So I think at times like this is maybe filter out the noise if you can. I know it's hard because it's on the news every day, but filter out the noise and just focus on those entry and exit levels. Kevin, what are your thoughts on that volatility and the signal to noise ratio? How do you approach markets like this?
Well, mainly I look at back tests and lots of trades. And of course, in trend following models, you're going to typically have more losers than winners. And so you have to sit through all of those losers to get to that winner that's going to keep going. And so it's just part of the process. It's frustrating. And we have political issues and wars going on and tariffs and so forth that are creating some economic chaos right now. And so it's not surprising that we have these choppy markets, but eventually things will trend again.
Yes, absolutely. And on a bright note, we're seeing some recovery to the highs for risk assets. The DAX actually leading the way. We've got the NASDAQ and S&P 500 at almost at all-time highs. And then, an interesting one here, Bitcoin. There is a futures contract, so we do trade it, and that's bubbling along almost at all-time highs as well. So, maybe things aren't as bad as they appear on the TV news.
All right, well, we might move on. Look, we've had problems with Jerry's reception. Look, we might have lost him for some of this podcast, but if he comes back on, we'll bring him back on again. But let's move on now to our next segment, which is Rising Stars and Trend Titans. So this is where we spotlight managers from our monthly report who stood out in the systematic space. And you can access this report on the ATS website. We'll have this in our show notes for this podcast. So it was a challenging month, but a few names continued to show consistency and discipline. So Adam, what stood out to you in May's report?
So I'm always fascinated by the dispersion of results because everybody in theory is trading an individual or idiosyncratic system, but then we're all playing in the trend following game. So we have correlations that are not one, but should be closer to one than zero, I guess, because we're all doing trend following or exploiting time series momentum. So it's always very interesting to see dispersion and then try to get to the nub of what's driving that. Is there alpha in that dispersion or beta or just good luck? Are people maybe doing things that are not 100% trend, which is obviously something that we would be poo-pooing here on the trend following podcast. But yeah, we are seeing some dispersion in results, but happy for those that are posting gains in May. And then we have had some quite large year-on-year losses here in some of these managers. So interesting to see, what's driving that, and without naming name. I mean, all the funds and details are here in your report, and I recommend that people go through and click on them. But what are your thoughts, Rich?
Well, it's interesting always going through this report because there does tend to be a high correlation between those that apply the same style to the market. So with trend following programs, during periods such as this, you would be expecting poor performance where trend followers were all sort of reaching their maximum drawdowns for the period. However, what this demonstrates, this report, is that there's a lot of managers classified within the trend following space who obviously have a lot of exposure to other types of systems, whether it's mean reversion, pattern recognition, different forms. It's not necessarily strictly trend following. So, you're dependent on your mix of your systems in your portfolio, and dependent on, of course, the universe that you trade, will tend to create this level of dispersion around the funds. But there is no doubt a big hats off to those fund managers that performed well for May. It was a tough month for trend followers like ourselves, but certainly a big hats off to them. You should always look at this in terms of long-term performance. So I always tend to, I'll give an overview of the monthly result, but then I'll immediately switch to the 5-year result to see how the funds are going over the longer term, because over a greater sample size, it tends to give me a bit more confidence in the program's capabilities.
I think the longer term returns, the 5-year KGARs and such, are probably more helpful for investors. But I love your dispersion chart, and I'm just trying to think of what's driving this dispersion, and why is dispersion falling? Because we seem to be at one of the lowest points of dispersion that you're monitoring here. Well, going all the way back to January 2020. And you think about it, I mean, we get into trends, we ride trends, and then we exit trends. And so, maybe are people getting in at similar levels and dispersion is reducing? Are people then managing their risk differently during a trade, so dispersion increases? And then are people exiting on different, parameters? Because whilst we're all trading trends, you've got an entry, you've got an exit, you've got risk management, and you've got position sizing that's driving everything. Maybe everyone's just got a lot less risk on.
I've got a theory here in that during periods of drawdown, we tend to converge with our level of dispersion. And this is because when you look at what really fundamentally drives our P&L, it's those outliers. So when we're in an outlier-free regime, when we're entering drawdowns and nothing's going our way, I tend to find that trend-following models tend to converge together in their level of performance, because there is less dispersion attributed to these significant moves that are driving the P&L. But when we come into favourable regimes, so when we're looking over the 5-year period of KGAR or whatever, we see the dispersion expand out based on who are the successful programs that are managing to capitalize on these significant material events, these outliers, which is pushing the dispersion away. So, for instance, any trend follower who, for instance, wasn't on that cocoa move, now that cocoa move was such a big player for 2024. Anyone who wasn't participating in that would tend to disperse significantly from those that were. And that's what I think is driving the dispersion. It's how we're attacking these outliers. So, Kevin, any thoughts here from your perspective regarding the dispersion and the report?
Yeah, I think that's exactly right. And what I try to do is focus on programs that are likely to be aligned with my objectives. So I'm not looking for 8% volatility, because there's usually a trade-off between the CAGR and the volatility that you're going to experience to achieve that. And so in these periods of drawdowns with trends that aren't sustained and lots of markets, I agree, you're going to see this, dispersion coming together, less dispersion. And then when you see those outliers, especially if it's outliers in just a few markets, then you're going to see performance being really driven by the degree of exposure to those markets with the outliers. And so I think that the CAGR versus max drawdown scatter plot there over 5 years is very interesting. It looks like there's kind of a nice log linear relationship there. I'd love to see that chart over a longer period of time. But, you see this relationship, and, it's an inverse relationship there for this 5-year period. And I think other 5-year periods might look very different depending on how many outlier moves there are.
Yeah. When you're dealing with in terms of things such as 5 years, that tends to capture maybe a single regime. But when we are looking at 20 years, you might have 3, 4 different regimes, 2 or 3. And of course, as you extend out in the years, you get access to many more different types of regimes. So even 5 years is too short, really, when we're looking at the overall performance. So yes, I think, when we compare 2008 to 2020, that was sort of one regime, post-GFC regime. We had a pre-GFC regime. Then we had a post-COVID regime. 3, 5 years, 10 years, that sort of thing.
If you look at returns over time, you see that managed futures trend following, the returns tend to cluster. And that does make it hard for many people to stick with because, you go through these periods with much higher returns and then periods with more modest returns. And so, 2008 and 2022 were both great years for managed futures trend following, just at the time when you needed it if you had a large equity allocation. But you can't predict when those next really good times are going to come. And so you have to sit through some periods that are choppy and, less performance. But you'll be awfully happy you had managed futures trend following once we hit another big air pocket in equities.
Something I can predict, Kevin, is that there'll be investors out there saying that trend following is dead at the moment. That's something I predict with a degree of certainty.
But so the data shows that blending trend in a material amount increases the risk-adjusted returns of the portfolio. So in geek speak, it's pushing out the efficient frontier. And the way I like to look at it, it's a form of insurance that you can add to your portfolio that has a positive carry. So instead of buying put options for which you pay away every year, every decade, and you will probably lose on in the long run, instead of doing that and hedging perfectly, you blend in trend following or managed futures, and you're effectively getting a diversifier, making more units of return per units of risk, because trend following has a positive expected return. What are your thoughts, Kevin?
Yep. Well, 2022 is a great example of when those option strategies didn't work very well. So you didn't have the sharp drop in equities. And so with the option strategies, during times when equities are doing well and you're insuring against large drops, you bleed a while until you get a sharp drop and then you get a return from the options. But in 2022, the options continued to bleed because you didn't have this sharp drop in equities. And so I think that there are various ways to diversify and hedge, and options are a true hedge. I think that trend following with managed futures isn't a hedge in by the traditional definition, but as you said, it's sort of a positive carry insurance policy. It's not going to protect you against the first punch in equities, but if you keep getting punched in equities, then that's really when you're going to see trend following help your portfolio.
Long vol strategies like options, they're negatively correlated, unlike trend following, which is uncorrelated. So there is no guarantee we're going to offer this degree of protection when equities turn south, but it does come into effect when we get these protracted, extended adverse crisis regimes, but certainly not with the short, sharp retractions. So if people are wanting a pure hedge, they would probably choose long vol, options-based strategies or whatever. But as Adam said, the downside of that is the ongoing need to protect, provide this insurance protection at all times with the long vol component. generally. I was speaking to Wayne Himmelson the other day, and it's not necessarily how he applies his approach. So that's a positive to Wayne. But in general, the long vol options play you need to maintain as an insurance premium at all times. So at many sort of regimes, there's this ongoing cost expense of maintaining that exposure to long vol. That's unlike trend following, which is when the opportunities arise, it sort of navigates or it adapts into that space with its uncorrelated portfolio. So in a general preference, I prefer sort of doing a material allocation of trend into something such as equities or a bond portfolio, purely because there is no ongoing cost of maintaining that trend component, and you do get significant, what I call the uplift of the portfolio attributed to the trend following characteristics of that allocation into that portfolio. So, swings and roundabouts, long vol, trend following, but I personally prefer the material allocation to trend.
Let's turn our attention to Dr. Kevin Mackey.
This is a segment called Spotlight, and we're turning the focus on you, Kevin. So let's start at the beginning. You move from biomedical research into systematic investing. So can you walk us through that journey?
Sure, although I'll say that they were really parallel journeys. So I've been studying investing since I was very young, and I've been a value investor from probably the early 1980s. And so I started as a hardcore value investor, and I still have a chunk of my portfolio allocated to value strategies. But in kind of the late 80s and early 1990s, I started to read about relative strength, initially with Bill O'Neill's book, with the CAN-SLIM method. So I started to study relative strength, and I did all right, but relative strength alone has these big drawdowns that are difficult to tolerate. And so in 2004, Michael Covell came out with his trend following book. I think I read it in 2005, and I started to test trend strategies. And I was testing them mainly on equities and funds. And I was very happy that in 2008, when we had a big equity bear market, that I was pretty heavily invested in trend strategies. So that saved me a lot of money. I had a drawdown, but it was a modest drawdown. And so then, of course, when things turned back up in 2009, I was able to get on board. And so the trend strategies combined with relative strength, so trend and momentum, or time series momentum and cross-sectional momentum combined, were really the way I've been investing for a long time, initially with funds, and then later on moving into individual equities with back-tested strategies. And I kept adding strategies. And so my objective has been to have complementary strategies so that there's always something performing well no matter what the market condition is. And so in recent years, I've sold some businesses. And I should say that while I studied epidemiology and nutrition science, I didn't go the academic route for a career. So I joined a private research company and ran a business unit there for 10 years. Then I went out on my own, sold that business, then co-founded another one and sold that business. And so I've been able to pursue investing on my own while running these businesses. My wife and I also ran a real estate residential rental business. And so I've had this kind of unusual career. Now I'm kind of in a glide path toward retirement from the biomedical research side and focusing a lot more of my energies and my research time on looking at systematic investment methods.
Yeah. Look, something that's really interested me is I want to know this. So how did your work on clinical trials and research design shape your thinking about evidence and statistics in finance? Is there a strong link there?
I think there's a very strong link. So when we're evaluating food or drug products, you start with a hypothesis. So you have something that you think might be of benefit. And so maybe you start with looking at history and say, as an example, is there a genetic variant that affects this biomarker that we think might be causally related to a disease? And you do some research, you find out it is, and then you design experiments to evaluate whether modifying this biomarker will modify disease risk. But you always have to incorporate uncertainty, and you always have to take into account that anytime we estimate the effect of something, there's uncertainty around that. And so we have to recognize that there are going to be false positives. There's a lot of noise, so you have this issue of signal to noise ratio. And so the same kinds of things apply to researching investment models. So you look back at history, and then you try to look at the robustness of your model in various ways. You try to apply the model to different markets, and then you want to apply the model out of sample. And then finally, at that point, I'm ready to start trading it live, and then I follow it over time to see if it's performing in the way it did historically. And sometimes it is, sometimes it isn't. If I have a model that I'm trading that isn't performing well, I often cut back on the size, but I don't stop trading it unless it gets so far away from the historical results that I think it's unlikely that that's due to chance. And in research, biomedical research, and in trading, I think there's always an element of chance. If you run thousands of statistical tests, you're going to get some false positives. If you test many, many models and model parameters, you're going to get some false positives. So you always have to be aware of the uncertainty, and that's part of the reason that I diversify across so many strategies. I figure some of them might break. It's hard to know statistically if something's really broken because it often takes years to really establish that that's true. And so what I say is, well, I'm going to do a lot of things that have worked historically, and my expectation is some of those will continue to work in the future, some may not. And so my goal is to identify those that are not performing so well and cut back on them and do more of what's been working. And then hopefully over time, by having a diversified set of models, I'll do all right.
Adam, have you got a question for Kevin? We'll sort of tic-tac between each other as we ask him questions.
So do you have a statistical method that would demonstrate that a strategy is broken? And would that be at the individual trade level? So, a series of losses or underperformance at the granular trade level? Or would you do that at the portfolio level, looking at the investment return of the strategy overall? How do you approach the issue of a quote-unquote broken system?
Right. So I try to look at both the win percentage, and so I'll have a series of back-tested trades, and so I'll have a 95% confidence interval or a 90% confidence interval around the win percentage. And then in addition to that, I'll look at the average payoff for winners and the average payoff for losers, or the average loss for losers. And what I'll do is I'll say, well, if I look at the distribution of winners and losers, both in terms of win rate and average payoffs, are they consistent with what I have seen in the past? And if I get one standard deviation away from past performance, I'm not worried about that. I know that these things are not normally distributed, and so, I'm saying standard deviation. I use standard deviation, but I recognize that more often than would be predicted by a normal curve, we're going to be in those tails outside of those standard deviations. And if I get two standard deviations away from historical performance, I start to get a little more concerned. If I'm 3.5 standard deviations away, I'm going to turn that model way down, maybe stop trading it, but I'm going to turn it way down and say, let's watch this for a while and see what happens. And if it starts to perform again, which has often been the case. My experience is most of the time the model's not broken. It's just going through a period that is way different from what has occurred in the past. And so it'll start working again in the fullness of time, but I'll turn it down until it does start working again. And so what I like to do is kind of not turn models off, but for the most part, I'll turn them down in terms of position size until I have more confidence that things are looking more similar to the way they've looked in the past.
And what tools are you using for this analysis?
So really, I'm just using basic statistics like z-scores and standard deviations and so forth. And a lot of my models are kind of for the equity models, they have win rates of right around 50%. So sort of 45 to 55%. And then they have payoffs that winners pay 3 to 5 times more than losers. And I have a holding period typically that's in around 120 to 180 trading days for most of the models. And so it's like flipping a coin. And so it's just a coin that you flip and it takes a few months to land and you find out your result. And so what I'm doing really is just looking at those statistics over time and taking rolling averages. So just to go off on a little bit of a tangent here, I'm very aware of noise and randomness. So a colleague and I once wrote a program to flip coins. So we did 100 sets of 100 coin flips, and theory would predict that 5 of those sets would be statistically significantly different from 50% heads. And just like theory would predict, that's exactly what we found. We ranged from 35% heads to 65% heads with 100 coin flips. And so, if I do 100 trades, and some of my models move fairly slowly, so it takes a while to accumulate 100 trades. If I do 100 trades and I'm in that range of 35 to 65%, I'm not going to get too worried about it. But if I do 100 trades and I have 19 winners, then I'm concerned that something's wrong, or I'm in a market condition that's just very dissimilar to what's happened in my back testing. And so that's, when I'm going to probably turn things way down and wait a little bit to see if this is going to come back, or if it continues to perform poorly, I might turn it off completely until it starts to perform again.
Yeah, and in practice, managers are going to run multiple models, and so there is an element of diversification, protecting one against, I guess you could call it bad luck, or a series of abnormal or statistically unlikely flips of a coin. And then above managers within a portfolio, you can still blend in multiple managers, giving more diversification, in addition to individual programs that you would run. So, going back to the current market context and the drawdown being experienced, how do you view the seriousness of this drawdown in trend following programs?
Well, I view it as not historically unprecedented. And so mostly with the managed futures trend following models that I outsource, on those, I'm, not overly concerned at this point. And I would say that, there are periods in the past when we've seen drawdowns that are this size or larger. Then on the models that I run myself, so I have 3 main categories of models, and I run all of them on different time frames and in different markets. And so from that standpoint, it may be that I see that, my longer term model is really working poorly right now, but my shorter term version of the same model is working well. And so there I diversify across methodologies and markets so that usually something's working. It's very unusual that nothing is working. And I do trend following. I do some mean reversion, but it's really short-term pullbacks in longer-term trends. And even those are not short-term. I'm not holding for a few days. The shortest models I have average hold times over 20 trading days. And so I'm, monitoring everything. And as long as what I'm seeing is within the range of what I've seen historically, I don't get too concerned. And when it starts stretching the bands of, getting close to the worst thing we've seen historically, then I start to take action and turn things down.
And so are you incorporating, fundamentals or news flow or research into this investment process, or is it entirely systematic and quantitative?
Well, I kind of split my portfolio into two halves. So one half is quality and value, and the other half is momentum and trend. So everything I do on the momentum and trend side is fully systematic. On the quality and value side, it's a combination of systematic and discretionary methods, but even the discretionary methods have some rules associated with them. So they're, sort of semi-systematic. But I also, have these high quality, long-term compounders that I do watch the fundamentals on. And if the price is going down, but the fundamentals continue to look good, I will likely hold on much longer than most will. And I say, essentially, well, I'm going to bet on history because this particular company has a long history of growing earnings. So I do pay attention to fundamentals on that side of the portfolio, but on the momentum and trend side, it's completely systematic, and it's almost all price driven. There's an element of volume, but mainly I use volume as a filter, and my entries and exit are based on price.
And Kevin, are you mostly sticking within the equities world, or are you also getting into futures, that sort of thing?
Yeah, I don't do anything myself with futures. I outsource that to CTAs and ETFs. And so my own trading models use equities and also ETFs, and the ETFs cover multiple asset classes, so equities, bonds, and commodities. None of my models use currencies. And so we mentioned platinum earlier, so I have a position in platinum that was triggered by one of my breakout models, and that's through an ETF, though not through futures.
Yeah. And so let's look at the allocation decisions. So you've mentioned how you look at the standard deviation effectively of returns over large sample sizes to determine with your trading models what to turn off and turn on, that type of thing. Is it the same in your decisions regarding allocations into program managers? Do you use the same sort of long-term view, look at the variance over a long periods of time, and if they have so many standard deviations away from the what you're expecting, that's where you cut them? Or how are you deciding when to stop allocating to, or when to increase allocations to?
Well, things have changed now that we have ETFs available with managed futures programs. And so with ETFs, I make a lot more changes. So number one, my initial investment is much lower. And then number two, I shift around because some of those I have in not tax-advantaged accounts or non-tax advantaged accounts. And so if I've got a loss in an ETF, I may sell that ETF in order to get the tax loss and then buy a different ETF that's doing managed futures trend following. So I am moving around a lot more with the ETF side. But when it comes to CTAs, I'd make very few changes. And when things are in a drawdown, that's when I'm likely to take some money from somewhere else and put it into the CTA. And, Marty Bergen from Dunn says the best time to buy a managed futures CTA program is during a drawdown, and the second best time is today. So I do tend to wait for drawdowns and then allocate more during a drawdown to a CTA. But that's a much bigger, the minimum investment for a CTA is much larger than an ETF. So with ETFs, if I'm in a 20% drawdown in an ETF, I may sell it and then just buy another ETF of managed futures trend following, so I can capture that tax loss.
Yes, it's always interesting when you're sort of timing an investment in trend following, because given that the backtesting shows a positive expected return, right, and that accrues over time, then by definition, delaying and waiting for a drawdown is probably going to reduce your return, because you don't know if a drawdown is imminent, and indeed the performance might the fund or the manager might actually perform and then have a drawdown, but you'll still be behind from the time that you invested.
Right, and I've got still funds coming in, and so when I've got funds coming in and I have to allocate them somewhere, I may be more apt to look at a CTA that's in a drawdown as a place to put funds that have come in recently than I would to say a model that's performed very well. And so in a sense, I am kind of using mean reversion across models and allocating more to those that have similar long-term expectation but have done poorly recently. Sort of dollar cost averaging, if you will, into different investment approaches.
Do you think that there is a mathematical model that can assist with timing the entry, effectively trading the equity curve of a manager? Because I did some, very elementary regression analysis, and the only thing that I could get was a relationship between the length of the drawdown and future performance, but not necessarily the quantum or the nature of it. So I don't know if you've got some clever mathematics that can help people with trading the equity curve.
Yeah, the short answer is I don't.
Well, that makes me feel better, given your quant skills.
What you just described actually is kind of what I've found to be true. The length of the drawdown has been the only thing that I've found that has some relationship to the return. But again, it's not a strong relationship. And what I've found is that it's really hard to predict, because trend following in managed futures tends to have these clusters of returns. So, lots of returns for a period of time, and then sort of modest returns for a period, some losses, and then again a big cluster. And so if you miss those clusters, you're in trouble. So I try not to miss the clusters, and any kind of reallocation and shifting around is modest relative to the overall position. And so if I'm in a CTA that's got a 20% drawdown and it's been going on for a while, as this has most recently, then I'm more apt to take some new funds that I've got coming in and put them over there.
And that's an interesting approach with the with the rebalancing, because what you're effectively doing is turning what could be a random decision with an unknown outcome into a bankable gain in respect of a tax loss. So you're effectively crystallizing some value when you do your rebalancing based on a potential tax advantage.
Right, and again, I do most of that tax loss selling with the ETFs because it's simple to do. I can, take that trade and it's done today, as opposed to trying to redeem from a CTA where I've got to notify them and wait to the end of the month, or even sometimes the end of the quarter, and that just makes it, more challenging and less nimble.
There's anything else in this series of questions that you'd like me to circle back on?
I did want to touch just on this issue of momentum quality, and that's something that I've been using that I haven't seen a lot written about or talked about on podcasts. And so basically with momentum quality, this is an idea that I originally, I think, read about in the book Quantitative Momentum by Wes Gray and Jack Vogel. And then it was also covered in Stocks on the Move by Andreas Klenau. And basically the idea is that a steady riser is going to be better with regard to risk-adjusted performance than something that is flat for a while, jumps up, and then goes flat for a while. And so I've worked out various simple but quantitative methods for assessing momentum quality. And what I'll do is if I have a certain number of spots to put equities into a model, I will rank based on momentum, but I'll also rank on momentum quality. And so I'm looking for higher momentum in a positive trend, but I'm filtering out using momentum quality, looking for the steady risers. And that, for me, was an improvement. So I consistently saw the backtest results, and then going forward, the results improve when I started to apply methods to look for these more steady risers as opposed to the things that are jumping around a lot. And that applies to both index ETFs and to individual equities.
Can you give an example of, two contrasting equities?
Sure. So let's just say that we have two equities. They're both in an uptrend, but one has been, flat for 9 months, and then in the last 3 months, it's jumped up by 40%. And I have another one that has gone up 40% over the same period of time, but it's done so slowly and gradually and with less volatility.
And is that up to the point of a breakout or a trend following signal? Are you looking at the behavior of the security prior to the entry, or is this once you're in a trade?
Yeah, this is actually part of the entry method. And so one of the approaches I use is a rotation model, where I'm going to look for things that are in an uptrend. I'll have a universe, and then I'll pick those that are in uptrend that have the best quality by my quantitative measures. And they're simple things like just adding up the return over 4 months, 8 months, and 12 months, or looking at the last 50 weeks and saying what percentage of those weeks were positive. And so if you see something that has high momentum, but it's got a small level of positive weeks over the last 50, I'm going to tend to filter that out as compared to something that's been a steady riser and maybe 35 of the last 50 weeks it's been positive.
Oh, very interesting. I think we'll all be off to our back testing engines to see if we can eke out a few more basis points on these back tests.
And it's helped a little bit on the Kager side, but it's really helped on the volatility side and the drawdowns.
Yeah, it would be interesting to have the quality of a breakout, the quality of a trend following signal, perhaps based on the prior performance. And I think that's a very interesting approach you've got there.
Yes, like I said, something I haven't heard spoken about a lot, and so I wanted to make sure we covered that because I haven't heard it too many other places.
I've got one other very hot topic, and that is what is your view on volatility control? At the trade level, and then also at the portfolio level. Is it something that you would implement or abdicate for?
On the managed futures side, I know that's a huge area of debate, and you have the classic trend approach versus the volatility management approach, and so I won't wade into that argument because that's not really my area of expertise. When it comes,
look, Jerry's not on the call right now, so this is your chance.
Yes, he has strong opinions. I am aware of those. But when it comes to the models that I use, I tend to buy either a breakout or I'm buying something on the basis of being in a positive trend with momentum, where I'm ranking on the basis of cross-sectional momentum. And I tend to allocate a certain amount to each model. And then within each model, I will have a default of equal weighting. But for certain securities that have very high volatility, I will cut back the weighting. So I sort of do equal weighting or 1.5 weight or 0.5 weight, just based on historical volatility. Then when I'm in the trade, I tend to stay in the trade until I get my signal to exit. I tend not to scale in or scale out of trades. I do have models on different time frames. And so from that standpoint, I am effectively scaling in and out of the same securities at times. But within a model, I'm going to buy it and then just wait for my exit signal. And I don't have profit targets. I don't have volatility control by scaling back if the volatility goes up. That's just not part of my systems.
And then finally, do you have any other broader advice for a data-driven investors?
Well, I would say that start small with anything that you're trading, test it, and test both from the standpoint of looking at history, looking at robustness. I have various ways of looking at robustness. I look at the same model in different markets. I look at different numbers of slots for a model. So I might have a model that has 10 positions, and I want to look at that same model with 20 positions and 30 positions. I also want to say, what if I skip the first 10 and then buy the next 10? How does that look? Also, with regard to robustness, I want to be in a zone that's favorable, but I'm not trying to optimize, because what has worked the best in the past is probably some guide to what will work in the future, but it's not going to be exactly the same. And so if your model is working at a 120-day breakout, but 130 days doesn't work and 110 days doesn't work well, then you're almost certainly over-optimized, and you want to be in a favorable zone for entries, exits, and position size. But over-optimization is the biggest challenge to developing a model to trade in the future, because you can't trade in the past. You can only trade going forward. And so I think that keep it small, keep it simple, not too many parameters. Every time you add a filter, you're reducing the sample size. And so that should reduce your confidence in the model. And then, I like to tell people, start with one model and then add gradually. Don't try and start with 5 models. Keep it simple, add one model at a time. Make sure you're confident from back testing, out of sample testing in different markets before you go live. Start small and then add models judiciously.
Well, that's great, Kevin. And look, thanks very much for sharing all of your insights. So look, unfortunately, on this show, we've been plagued by tech problems. So we lost Jerry, and also I lost a lot of sound during that last few minutes. But look, hopefully the recording all comes through okay in post-production. But look, I just wanted to say many thanks, Kevin, for joining us today. It's marvellous hearing your viewpoints, particularly not only from your own trading ideas, but also on your ideas regarding allocation and investment. It's great to have you, and don't be a stranger, and we hope to see you again in the future. I hear that you're planning to come to Australia towards the end of the year, so look up Adam and me. You're looking forward to that?
Very much looking forward to it. I've been to Australia several times, but my wife, our 2 adult kids, and my son's girlfriend are coming with. So it's going to be a great adventure for them, and I'm really looking forward to it.
Have you been to Australia before?
I've been to Australia several times, and it's honestly one of my favorite spots on the planet. So I can't wait to share that with my family.
Well, the last time when Jerry was over here in Australia, we had to convince the wildlife to come and visit him. So we had a local parrot coming and stopping on his shoulder. So we might have to do something similar when you come over here. Might get a wallaby to come up and visit you. But no, looking forward to seeing you when you come over.
Thanks so much for having me on as a guest.
Excellent, guys. So next month we'll have another guest on our show. So keep posted to that. So many thanks, listeners, for listening to today's podcast with Kevin Mackey. It's been wonderful, and I hope to see you soon. And keep posted. Until then, stay systematic, stay curious, and may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.